one ETF portfolio is one of the simplest and easiest way to grow your wealth over time without complicating your long-term investing strategy. You only need to buy one ETF and hold it forever. Although this might sound too good to be true and having all your money in one fund seem risky or daunting to some investors, it's a strategy worth considering. But when you want to grow your portfolio like a professional, you have a problem because you don't have the expertise and the time to check all the news and upcoming information about the market 24/7, right? And as a financial advisor, I've observed many investors facing poor returns and making mistakes such as having too much overlap or being overly diversified in their portfolio. And let's be honest, sometimes investors avoid ETFs altogether because the overwhelming number of options, right? So what do? They outsource their money to a professional asset manager, hoping for better returns. But in my experience, they often pay too much fees for low returns in the end. But I have good news for you because there is a really easy alternative that doesn't require the expertise of a financial expert, cost you way less money, and give you better returns than the average professional asset manager. So sounds good? So in this video, I will cover some of the best broad market ETFs for a one ETF portfolio, evaluating them based on total return potential, cost, volatility, diversification, and of course risk. You can buy and hold these forever, even if you don't follow the markets closely, and still achieve greater returns of 10% or more per year over the long term. So let's dive in. So why should you invest in a broad market ETF? Broad market ETFs are great for a one ETF portfolio because they include hundreds or thousands of stocks from various sectors. And this means if one stock or sector performs poorly, others will help balance out your portfolio with good returns. And the good part is that you are not over diversified or having too much overlap. So my top two choices are simple and really easy to buy. The first one is the S&P 500 ETF, the VOO. And the second one is the total market ETF, the VTI, both from Vanguard. VOO tracks the 500 largest companies in the US, while VTI covers the entire US stock market. The VOO focuses on large cap stocks, whereas the VTI includes large cap, mid cap, and small cap stocks. Both ETFs are highly similar in returns and have significant overlap. 99.6% of VOO's holdings are also in VTI. And this is why I don't recommend holding both in the same portfolio. And remember, VOO and VTI have both low volatility and historically steady returns. Since the S&P 500 introduction in 1957, it has returned an average of 10.4% per year. And this long-term consistency is very appealing for growing your wealth over a longer period of time. And be careful here, because you might encounter financial experts advising you to exit the market because it's an all-time high at this moment. But remember, very few financial experts have consistently outperformed the market over a minimum of 15 years. So trying to time the market is riskier than staying in the market. Even investors like Warren Buffett have faced market downturns of 50% or more multiple times. So please be careful whom you listen to. Okay, returning to the ETFs. VOO offers high diversification among large cap stocks, while VTI provides even more diversification, including small and mid cap stocks. Both ETFs are low risk due to their diversification and long track record of strong returns. They also offer decent dividend yield for passive income. However, you should be aware of this. When I say a low risk portfolio, I mean low risk for the long term. Yes, your portfolio could experience a downturn of 50% or more in the short term. But the longer you invest, and I mean 10 years or longer, the lower your risk of losing money becomes. And this is supported by data, so this is very important. Another option is the Total World ETF, the VT, which includes US and international stocks. The VT provides the broadest diversification with almost 10,000 stocks from all around the world. Although VT has historically underperformed compared to US only ETFs, it could perform better if global equities start to outpace US stocks in the future. I discussed this economic cycle in this video, making it very simple for you. So my advice is to keep things simple and avoid overcomplicating your investments. VT has low volatility and similar movements to VOO and the VTI, but includes global exposure. Its diversification across many countries and stock sizes makes it a strong choice for those seeking worldwide investment exposure. The VT also has a higher dividend yield compared to US stocks. Overall, any of these three ETFs, the VOO, the VTI, or the VT, could work well for a one ETF portfolio strategy. And the best part is that they all only cost you between 0.03% and 0.07%. And remember, Morningstar studies have consistently shown that lower costs in your portfolio directly correlate with higher returns. This is because lower expense ratios mean more of your money is working for you rather than going towards fees. So choosing ETFs with a low expense ratio like VOO, the VTI, and the VT can significantly help your investment returns over the long term. And remember this important quote: the best performing investors are the ones who are dead. Yes, you heard that right. Fidelity, one of the biggest asset managers in the world, conducted a study on their best performing client brokerage account. Over a 10-year period, they found that the highest returns came from the accounts where their holder was deceased. The second best were accounts that were forgotten. And of course, I don't recommend dying as a good investment strategy, but I think you get my point. So, as you know, there are many investment rules that can help you avoid common pitfalls and benefit your returns in the best way possible as an investor. In this video, we have one of the best interviews covering the 26 best lessons Jack Bogle learned over 68 years of investing. These lessons will definitely assist you on your investment journey. And if you want to stay up to date on investment tips, please hit the subscribe button and let me know in the comments which ETF you prefer.